Throughout our market overview, you've heard us discuss many areas where private markets are performing below historical levels. So we have to admit it's never felt so good to be almost average, at least in one area, the rate of investing. You might be surprised to see that the rate of investing is only slightly below historical private market averages, at least for private equity. In absolute terms, across private markets in aggregate, 2025 rivaled the peak years of 2021 and 2022. Private credit and real assets are tipping lower. Private credit, many have been asking, are we still in the golden age? We think so, but as the regulation on the banks loosens, maybe this is what it looks like when the banks start fighting back. Venture, perhaps not surprisingly, has rebounded to average levels, driven by the investments in AI-related companies. Now, the chart you've all been waiting for. And the chart that we love to tell you every year is the least important one you will see in our dataset. Here we see the private market's dry powder levels going up and to the right consistently for the last 10 years. It's actually been the same more or less for the last 30. For years, many have loved to point to this chart to argue that there was too much capital chasing too few opportunities, which would naturally lead to lower returns. We've heard these voices grow louder in the last couple of years, as pundits and skeptics look gleefully at the private market underperformance. But those of you who've heard us talk about this before will already know that we have a totally different read on these numbers. We see them as a reflection of healthy market growth and have never seen a correlation between returns and dry powder. So let's move on to data that does matter, the time to deploy that capital overhang. A lot of it is noise, but there are interesting indicators when the time to deploy hits elevated levels. Right now, for example, buyout and credit are indicating that they could be entering more favorable periods. Again, this brings us back to our more positive view on private credit than many others. While one indicator should not be used alone, this chart does suggest that now may be a better time to invest in those areas than prior years.